So this next module is about really trying to get at the economics of this beta concept. What does the beta mean? What is the significance of the beta? Mathematically, if you look at beta, how is it computed? Mathematically, the beta of, say, McDonald's, MCD McDonald's stock, every stock, everything that trades on the market has an associated beta. And you can, as I said before, you can get these betas off of the websites. The beta of McDonald's, for instance, is the covariance mathematically between the return on McDonald's and the equity market divided by the variance of the equity market. Okay, so as you can see, this is the numerator is the covariance between the return on McDonald's and the return on the, say, the market, which is the S&P 500, and this is divided by the variance of the market or the S&P 500. That's what the beta is. Okay, so the higher this covariance, the higher is the beta. And so we say the higher the covariance, the higher the beta. The higher the beta, the greater the risk. Right? That's what this means. Because remember, in this model, when your beta goes up, what happens? The expected return, in this case, of McDonald's will be the risk-free rate plus this beta of McDonald's. And if it is high, it's going to be multiplied by the market risk premium and then added. So this is going to increase. So higher the beta, higher the risk. What is the basis for this? Why is it the case that beta measures risk, right? Why is it that covariance with the market, the higher the covariance with the market, the higher the risk? One way to think about that is, what is risk when it comes to stocks? Why do stocks move? Meaning, why does their rate of return change? Why do prices change? Two sources of risk, broadly speaking. One is what we call general economic risk. Business cycles. Economy goes up, economy goes down. Affects all stocks. Affects all stocks across the market. Interest rates change. Exchange rates change. Employment factors change. Business conditions change. All these things affect all stocks in the economy, and that's the source of what we call general economic risk, or what's called systematic risk. Sometimes this is also called systematic risk. Okay, it affects everyone, everything. And then there is firm specific risk, which only affects a particular firm. So McDonald's, for instance, maybe they recently won a contract to supply burgers to the army in Afghanistan. Or they lost a contract, or they were affected by a lawsuit. That is only specific to the firm. That's what we call unsystematic or firm-specific risk. So unsystematic, sometimes called idiosyncratic, because it's only specific to the firm. That's the second source of risk. Broadly speaking, you can think about these. This is 1 and this is 2. Okay. The thing that's important to keep in mind is that firm-specific risk can be managed. Okay, can be managed, meaning can be controlled to some extent by an investor, in the sense that you can think about forming, instead of holding just McDonald's stock, you can hold McDonald's stock and you can hold, say, some other restaurant stock or something else. You can put stocks together in a portfolio so that when McDonald's does badly, the other firm, if it's correlated in a way that the other firm does well, when one does badly, then you sort of hedge your risks, right? So that kind of portfolio diversification, where you try to manage risk by including assets that don't move with each other. One does poorly, the other does well, and they balance each other. That diversification will help you control firm-specific risk. But you really can't change general economic risk, market risk. All stocks face that. So diversification helps you manage one risk, firm-specific risk. It does not really help you manage the other risk. Okay? As a result of that, if you look, this is what happens. As you increase the number of stocks in your portfolio, right? This is your portfolio risk. This is the number of stocks you own. Initially, you own few stocks and your risk of your portfolio is high. As you increase the number of stocks, as you move in this direction from say 0 stocks to 10 stocks, your risk of your portfolio goes down quite a bit. Keeps going down, keeps going down. At about 30 stocks, that risk sort of evens out. And then after that, it's about level. Doesn't go down any further no matter how many more stocks you introduce. This thing here, what's left, there's still some risk in your portfolio, right? You were able to reduce the risk substantially in the beginning, and then you're left with some risk. What is left is what we call market risk or systematic or economic risk, general economic risk. What you were able to control through diversification was this firm-specific or unsystematic risk. And what the beta tries to capture is this market risk. That's why beta is a good estimator of risk, is because it only captures the risk that's relevant. It ignores all this. Why? Because smart investors can diversify this risk and reduce their risk and reduce it to this point. At this point, what remains is market risk, and this is what's captured in your market risk premium. And stocks with high betas are stocks that when something bad happens to the market, they get affected even more. Something good happens to the market, they enjoy the benefits even more. And that's what risk turns out to be in this world. Okay, so that's the basis for using the beta as a risk measure. If you look at this, you can see that this is just from your text, and this is all dated. So these betas will change as of 2013. Just going through this list, look at a firm like say P&G or Kraft Foods, relatively low betas. Okay, that's not unusual. On the other hand, say GE or JP Morgan or the banks, right? Economy does very well, especially in this time period. They probably can do better than the economy. Economy does poorly, they do worse than the economy. And that's what these are high betas, right? 1.8, close to 1.96, close to 2. A beta close to 2 is telling you that when the market goes up 10%, the stock goes up 20%. When the market goes down 10%, the stock goes down 20%. To some extent, that's the nature of what they sell, their assets, but it's also based on some other factors. Okay, so let's talk about a little bit more about beta. What does beta depend on? Beta depends on two things. A firm's beta depends on two things. One, it depends on what are the firm's real assets, meaning what is it they sell? Are they selling pizzas or are they selling Tesla cars? Because the market for these is very different. Teslas, people buy them when the economy is doing well. Maybe they don't buy them when the economy is doing badly. Pizzas, maybe not so elastic, maybe not so variant with the market. What is their cost structure like? Do they have fixed assets? If they have a lot of fixed assets, they need to generate revenues. They can tend to have high betas because fixed assets have to be paid for even when the market does poorly. So the market does poorly, they still have to pay for their fixed costs and they do worse than the market. So to some extent, it depends on the business risk. But it also depends on how much leverage they have. How much debt do they have? The more debt a firm has, the equity holder, the stockholder's risk goes up, right? If you invest in shares of a firm that has a lot of debt, then your claim, if the firm were to go into bankruptcy, is later down the line because all these debt holders have to be repaid. So firms with high business risk do not take on debt because this makes them even more risky. One way of thinking of separating these two factors, and I'm not going to go into the formula or the derivation, but this is how it's done. The equity beta, this is what you normally see published. The previous table I showed you, any website will have the firm's BE is the equity beta of the firm, has two components. One is the underlying business risk coming from the risk of the assets, and the other is coming from the debt to equity ratio, from this leverage. So, and then if we control for the tax rate, really this is the equation that you want to keep in mind. Okay, beta of assets affects the business risk. What kind of assets do they have? How risky are those assets? Are they pro-cyclical? Are they counter-cyclical? How do they move when the economy moves up and down? The second thing here, which is the debt to equity, So beta of assets affects 1 and debt to equity affects 2. Okay, and you can think of both these as more or less independent. One is based on real assets. This is CFO's choice or the board's choice. They can change this, right? They can decide to issue more debt or less debt. More or less they have control over it. This they have less control over. Think of these two factors as more or less independent, and also remember that in general this does not change when a firm takes on more debt or takes on less debt. The business risk is not altered by the financial risk, generally speaking. Okay, when debt to equity changes, but what happens when this debt to equity changes? The equity holder's risk goes up, although the underlying assets have not changed in terms of risk. So it's like saying, let's say you own shares in Pizza Hut. As long as they continue to sell pizzas, this beta of the assets does not change. But on the other hand, if they take on more debt, then if you're an equity holder now, your stock has become riskier, not because of the business risk, but because of the financial leverage. Okay, so as a firm plays with its debt to equity ratio, this changes and hence BE changes, but the beta of assets does not change. Okay. The only beta you will see published on websites is the beta of the firm's equity. The asset beta has to be inferred using the equity beta. Okay, and so I just work through these numbers for the Home Depot example. If we use this formula and we know that the Home Depot's equity beta was 1.03, which is the published beta, we know their tax rate, we know their debt equity ratio, then we can back out their underlying business risk using this formula, and that turns out to be 0.93. Always remember this, the underlying business risk can never be greater than the equity risk. The equity risk can be greater than or equal to this, because even if they have no debt, right, even if the firm has 0 debt, and so they have no financial risk, even if this is 0, they still have some business risk as coming from their beta of the assets. Okay, so with that, we finish the just one more slide, just you can read through this. But the bottom line here is the beta really captures that market risk, because that's the risk that matters. The beta that you see published has to do with the risk of owning stock, which comes from 2 sources, the business risk and the financial risk. Business risk in general does not change. It only changes when the firm decides to do something new. So if, let's say, Home Depot decides to invest in the computer business or the software business, that's a whole different business risk. Then that beta of the assets is going to change. But so long as they don't change their business and only change their debt to equity ratio, the beta of their assets does not change. What changes is the beta of their equity. So that's the discussion on beta. Again, this is more to help you understand what beta means and when it changes. Okay, so with that, we finish our discussion on the weighted average cost of capital.